The Fed's preferred gauge of inflation is still much closer to 3% and their target 2%, but markets seem to be happy with it. Bonds are rallying, the dollar's down, and stocks are up. Let's talk some more about the number and how to work bonds into the portfolio with David Rogal, Managing Director and Portfolio Manager of the Fundamental Fixed Income Group at BlackRock. David, thanks for being here this morning.
Thanks for having me.
Okay, we got a number here after several other inflation prints that were a little bit warmer. This one just meeting expectations. How do you think that fits in to the Fed's plan and the way we generally are thinking about interest rates?
Yeah, I think the number this morning was largely expected to be firmer. So I think the market, was well anticipating that. We saw sticky services inflation in the January CPI. So I think the market was expecting a firmer number today. I think the most important thing really will be whether or not we see confirmation of the services inflation strength in the February data and how the February jobs data plays out. So if we're going to see more follow through in the bond market, I think we have to wait for that data to find out.
Should this change any of the timeline that's been forming for the Fed's cut, which right now seems to most likely begin in June?
Yeah, I think we're right there as well. And if you look back, this year has been really interesting. There was a significant miscalibration between what the market was expecting for the Fed and what the Fed actually wanted to do. And I think if you look at the pricing today, we're in a much better place with where the front end pricing is. We still think a mid-year start for the Fed is sensible. The Fed went from a hiking bias for most of last year to a neutral bias in the January statement. It's going to be a big deal for them to move towards an easing bias. And we think, you saw that in Powell's 60 Minutes interview. He said it would be consequential when the Fed moves to an easing bias. They don't want to restart the inflation process. They want to make sure that inflation is behind them. I think the most interesting question is really where the interest rate goes this cycle. And I think there's reason to believe that, the terminal interest rate for the Fed is somewhat higher. We have an economy that's held up extremely well with high interest rates. And we have a significant amount of borrowers in the economy that have termed out. So if you look at the average mortgage rate, it's below 4%, whereas the rate on a new mortgage is closer to 7%. So I think it's not our view that the neutral rate has increased. It's just that the economy is less sensitive to short-term interest rates. But overall, we think a mid-year start for the Fed makes sense, somewhere between 50 and 100 basis points of cuts, provided that the inflation data continues to improve.
I want to probe that neutral rate conversation a little bit more because I think it's super important given so many economists were expecting the so-called lagged effects of their extreme hiking policy to sink the economy. Instead, what we got was a little bit of a slowdown and then something that looks like a bounce back. GDP's now going 3 quarters in a row, well above what anybody thought we'd be at this point. Even some of the softest areas like manufacturing PMIs are looking to get closer to 50 and maybe even start expanding. How come we haven't had that hit? Were rates constrictive when they were at 0 or close to it? Is there some sweet spot there that actually might have stimulated this economy getting off the zero bound?
Yeah, I think it's like it's like I was saying before. I think there's a few other factors. There's we're running a cyclical fiscal policy right now in the economy. We're going to run a 7% budget deficit with a 3.7% unemployment rate. So that's certainly been underpinning growth in the U.S. economy. And it's like I said, I think the economy is not as sensitive to short-term interest rates as people assume. We have a significant amount of the economy that's termed out debt and is operating with relatively low fixed rates. I think, though, when you look at the bond market valuations today, and we're pricing around a 3.5 to 3.7% terminal interest rate. We have investors sitting on a ton of cash today. And I think what you'll continue to see is, even though interest rates may remain higher, I think you're going to see investors start to move out the duration spectrum and extend duration into kind of intermediate fixed income. We think it's a great environment for active fixed income. We just recently launched our active Total Return ETF, which is modeled off of our Total Return Mutual Fund product. We think this will offer investors more transparency into the product, ease of access. We think it's a great product that can be used to start gradually moving out of cash into intermediate fixed income.
When you define cash, is that basically like the T-bill trade that a lot of people were parked in very short term? Kind of some of the money market fund type stuff. People didn't know what to do after the stock bear market. Is that where you think the money's going to come out of?
Yeah, there's a lot of dry powder out there. You've talked about it on your show before. I think we have over 6 trillion in money market mutual funds today. There's a lot of dry powder for investors to start to move out the spectrum. Bond allocations are relatively low. It's difficult to time. We looked in prior cycles. It's paid to extend duration when the Feds stopped hiking interest rates. I think the difference coming into this year were the valuations. Valuations now are much more interesting, particularly in the front and intermediate part of the curve. Even if you have a zero fixed income allocation in your portfolio, you're supposed to be moving some of that into something like total return. If you have a more reasonable allocation of fixed income, you can be gradual on that approach. I think the interesting thing for the bond market this year and has been the fiscal dynamics. So, there's a supply demand imbalance. We think the household has, ample ability to absorb all the supply coming in fixed income, but, it pays to be patient. We think there's going to be more term premium out the curve to absorb the supply, but something like total return, high quality, intermediate fixed income product, we think it's a great way to start extending out of cash.
Okay, tell us more about what's in that BRTR, the active fund. A lot of treasuries, some mortgage-backed securities. Where specifically is the highest concentration right now?
Yeah, well, the thing I'd emphasize with the strategy is the flexibility. We're benchmarked to the ag index, but we have a broad flexibility to move into global fixed income, below investment grade credit, global interest rates, and right now we're actually providing around a 60 to 70 basis point yield advantage in the product with a lower overall portfolio volatility and a more diversified allocation. Right now, we've been moving towards agency mortgages, which are historically, if you look at spread assets, they've done extremely well since October, since the peak in yields in October. Agency mortgages are one area that we think on a longer horizon actually look fairly attractive in a portfolio context in a high quality spread sector. We think it'll do well as interest rate volatility starts to come down. And we have one of the best securitized investment teams in the industry. We have about a 15 to 20% overweight to securitized assets. We think we can enhance return for investors and provide interesting security selection opportunities over the next couple of years in those sectors.
How does it fit in from an allocation standpoint within the general fixed income category? Does it provide some of the return that you might get in the credit side of a fixed income as well, or is this generally more kind of a replacement or a offering to meet the treasury, the safer side, the more kind of traditional fixed income approach?
Yeah, well, our index is very government heavy, but we take a broader, more diversified approach. So we view it as a flexible multi-sector product where really we can pivot to the opportunities in the global fixed income sector. So we're going to be dynamic around our sector allocation. Right now, we have a fairly high average credit quality. We're at around a AA average portfolio credit quality. And that's just given where valuations are and our view on the economy. We think that's the better opportunity. But certainly if valuations were to change, we can pivot. And I'd view it as a flexible, multi-sector approach.
Okay. If I'm an investor watching the stock market melt up, Bitcoin prices ramping, Russell trying to break out, if I'm moving my cash out of short-term money market funds, why don't I go into the higher risk stuff? Why just shift it along kind of the lower return spectrum and not go for the gold?
Yeah, it's a great point. We've had the equity markets doing well. We got Bitcoin up every day. I think it depends, where you are. I think if you're more conservative, maybe closer to retirement, you're allocating more to bonds. You're actually able to achieve a positive real rate of return in high quality fixed income today. You couldn't do that before. And something like the BlackRock Total Return Fund, it's going to be a diversifier in a portfolio. To the extent that portfolios have lower bond allocations, you want to have some allocation to a high quality product like that. That if something bad happens in the economy, something unexpected, it's going to work for you. Actually, I would highlight that if you go back to 2022, bonds were a terrible hedge for stocks. And really the wedge there was the high inflation rate in the economy. As inflation comes down, bonds are going to be a better hedge for stocks. It's you're going to get more diversification in your portfolio, and you're doing that while achieving hopefully a positive real rate of return, unlike what you were getting in the decade after the financial crisis.
Good point. So to bring it all full circle, the risk then would be inflation sticks around for too long, too high, the duration trade doesn't work, Fed can't cut. Basically, that's kind of the risk here in the trade.
Yeah, I think if we, listen, we place a fairly low probability of the Fed hiking interest rates. We do a lot of work on the inflation path. We have one of the, fantastic economics team, and we're still constructive on the inflation trajectory overall. But yeah, that's the risk for bonds, and even a situation where the Fed's not easing this year, the market's still pricing about, 80 basis points of easing in 2024. So that is certainly a risk to the bond market. I think the Fed's told you they want to do that. They're going to have to start easing before inflation reaches their target. We'll have to really watch the inflation data over the coming months. But I agree. That's the main risk for the bond market at this stage.
All right. David, thanks for the conversation. Good stuff. Appreciate it.
Thanks for having me.
You got it. David Rogal, Managing Director at BlackRock BRTR.